A fish swims into the reef bank on a Tuesday morning. He deposits his pearls. The teller smiles, hands him a shell receipt. He leaves calm. My pearls are safe. They're growing. The bank is taking care of my future. Shark watches, and Shark knows this is the ocean's most comfortable illusion. A bank is not a vault. A bank is an engine, and you just fueled the machine. You are not just a customer. You are capital. When you deposit money, it doesn't sit there waiting for you. You are lending it to the bank. And the bank takes your pearls and lends them to another shark at a higher interest rate. The difference? Profit. You fund the system. The system charges the next shark. The engine keeps running. Poor shark thinks the bank works for him. Shark understands he operates inside the system. Money is born from debt. Here's what most sharks never realize. When a bank issues a loan, it doesn't simply hand over someone else's money. It creates a new deposit. Your balance remains. The borrower's balance appears. The ocean just gained more money. No new treasure was found. No new pearls were mined. Credit creates money. And whoever controls credit influences how much water fills the financial ocean. More credit, prices rise. Less credit, everything tightens. Shark rich watches credit expansion. Poor shark watches rising prices. One understands the cause, the other reacts to the effect. Interest is the tide. Interest rates are the tide of the ocean. When rates rise, payments rise. Businesses slow. Poor shark feels pressure. When rates fall, credit expands. Prices climb. Poor shark feels smart. But it wasn't brilliance. It was the tide. Shark Rich doesn't celebrate waves. Shark Rich studies tides. The most profitable trap in the ocean. Credit cards are marketed as rewards. Points, miles, cashback. And yes, those exist. But the real profit comes from carried balances. 5,000 in debt at 20%. That's 1,000 per year just in interest. Year after year. Poor shark collects points. The bank collects predictable cash flow. Shark Rich never ignores the math. Why Shark Rich pays less than you? Poor shark uses debt to consume. Shark Rich uses debt strategically. If Shark Rich owns assets growing at 10% and can borrow at 4%, he doesn't sell the asset. He uses it as collateral. Low risk, low rate. He pays 4%. The asset grows 10%. Same tool. Completely different outcome. Risk determines rate. Rate determines trajectory. Poor shark pays more because he represents uncertainty. Shark Rich pays less because he represents stability. It isn't emotional, it's mathematical. The system runs on confidence. Banks do not keep every pearl available at once. They never have. The system works because not every shark withdraws at the same time. It runs on confidence. If confidence breaks, the structure shakes. That's why banks invest so heavily in image, stability, and trust. Confidence is the most valuable invisible asset in the ocean. Without it, the system collapses. It's not conspiracy. It's incentives. Banks are not villains, they are businesses, and businesses maximize profit within the rules. The issue isn't that banks exist. The issue is playing the game without knowing the rules. If you don't understand credit, interest, risk, incentives, you become part of the margin, small fees, small interest, repeated decisions, massive difference over time. A smart shark advice to you? Shark doesn't hate banks. Shark understands banks. Use them for safety, payments, liquidity, but never confuse that with wealth creation. Understand the current, understand the tide, understand the incentives. Poor shark drifts. Shark Rich navigates, and in the financial ocean, the current never stops.